Okay, so these questions, let me just repeat it, is questions that came out of past papers. Now, the first thing you have to do when you do a question is you go to the you are required to. So what is required from you? So in this question, what they've asked you is for each transaction above, so there's 4 transactions, indicate the primary source document. Okay, so what source document are you going to use? You must indicate if it is an original or duplicate. Okay, and no abbreviation, so you have to write it out in full. Then the primary journal in which this transaction will be recorded. So what journal entry will we record this transaction? And then also the impact on the general ledger. So meaning what account will be debited, what account will be credited. And then they also asked you to show the effect on the accounting equation, and you can ignore that. So what they're testing here is they're testing Learning Unit 3, our source documents. They're testing the journals, Learning Unit 4, and Learning Unit 5, and Learning Unit 6. And then they're also testing all those learning units, the general ledgers that we discussed when we did the journals as well. And then the last thing is we're testing the accounting equation, Learning Unit 2. So in one question, we are testing 4 learning units. Okay, and then they gave you a little hint to say asset equals owner's equity plus liabilities. Now, the reason they give you that hint is to help you balance your accounting equation and to make sure that what you have on the one side equals the other side, to know that you are balancing. And then they specifically say round all amounts to the nearest rand. So if you see this in a question, you round it to the nearest rand. If you don't see this, you round it to the second decimal. Okay, now let's go, and then they've given you an example of what the table would look like. Now the table was provided in the test, so I've created a copy, so we'll work on that. Okay, so let's go look at the first transaction. So the first transaction is we purchased inventory on credit. So this means I've purchased it on credit, so my journal that I will have is my creditor's journal. When I have a creditor's journal, I would have the original credit invoice is what I would have received. Okay, for 61,440 Rand. And then they tell you we use the perpetual inventory system. So as soon as we see perpetual inventory system, we need to know we're going to use the inventory account, which falls under the asset category. Okay. Now just thinking about it, we know, okay, if we purchase inventory, inventory increases on the debit side, okay? And because it's on credit, we're not paying for it in cash yet. We will credit creditors control, which is a liability. Okay, so as you go through the information, this is what you need to do in order to process the information. So as you read it, you think, based on what the required is, what do I need to answer exactly for that question? Okay, so let's then go populate it onto the solution. So our source document, we said, is our original credit invoice. Okay, the journal would be the creditor's journal. We're going to debit the inventory account because we're using the perpetual inventory system. We're going to credit creditor's control. Okay, now when we do the accounting equation, it's very important that you indicate the plus and the minus sign. Because if you do not indicate it in your test, you will not get the mark. Okay, in the assignment, I did mark it because of the fact that some of you use Excel files, and I know that the plus doesn't always show in the Excel file, so I gave you the benefit of the doubt. But in your test, you need to properly indicate the signs. Okay, so we know inventory is increasing. So increases on the asset side, so the assets will increase, so it's a positive with 61,440. We know creditors control is a liability, so liabilities will also increase. How do I know I'm balancing? Assets equals owner's equity plus liability. So plus 61,440 equals plus 61,440 if I do the basic equation. If I put a minus here, it would have been a positive on the one side and a negative on the other side, showing me that my equation does not actually balance. Okay, then if we move on to the second transaction. Credit sales of 40,740, and we assume a periodic inventory system, and there's a markup of 100% on the cost price. Okay, so the first thing, credit sales, we know credit sales goes to our debtors journals. If we have a debtors journal, we have a duplicate credit invoice because we gave the original to our client or customer. Okay, because we're on the periodic inventory system, when we have a sale, we only have one double entry transaction. So there's one entry. Let me just write the double entry. And that is for the sale. So there is no cost of sales required. Okay? Because we do not have a cost of sales column under the periodic inventory system, we only account for cost of sales at year end. Okay, so that means this markup information is irrelevant. We do not need to know what the information is. Now, if we think about it, we know, okay, credit sales, so that would mean we debit. We don't debit bank because we did not physically receive cash, so it will be debtors control, and we would credit sales as the other side. Now, debtors control is an asset account, whereas sales would affect our owner's equity in a positive manner. Okay, so let's go fill it in on our template. So we said the first thing is a duplicate credit invoice. We take it to debtors control. We debit debtors control, debtors journal, and we debit debtors control, and we credit sales. Okay, we do not do a second entry for the cost of sales in terms of the periodic inventory system. This is where a lot of students normally make a mistake when they get confused between perpetual and periodic. And then we debit the assets, so the assets will increase with 40,740, and sales will increase owner's equity because it increases our profit, so it affects our owner's equity on a positive manner. Okay, then if we go look at the next transaction, the owner took inventory with a cost price of 2,250 Rand and a sales price of 4,500 for his private use. Okay, so the owner took inventory, which is called drawings, for a cost price of 2,250 Rand and a sales price of 4,500. You can tell me, when the owner takes inventory, at what value do we remove it out of our accounting records? If our owner takes inventory out of our stock, at what value will we remove it in our accounting records? Okay, that's absolutely correct. At cost, we will remove it at cost. So what they're doing here is they're giving you the cost price and the sales price to confuse you, to see if you know that. Okay, and then we've got the perpetual inventory system, so it's going to inventory. Okay, so this type of journal would be the general journal because it does not belong under your credit or your cash journals. For your general journal, we will have a journal voucher. It will be original because it is our journal that we've written. The accounts that will be affected will be as follows. So we know drawings will increase, so the owner increased its drawings. So drawings increases, which affects owner's equity, but negatively. And then we will credit the inventory because inventory is decreasing, which is an asset. Okay, so let's go fill this in on our sheet. Okay, so we said the journal voucher, it will be an original journal voucher because it was a voucher that we've created. It will go to the general journal. We would debit drawings. We would credit inventory because of the fact that it is a perpetual inventory system. Now, inventory is an asset account, so because inventory is credited, we will reduce inventory. So it's a negative 2,250, so the cost price. And drawings will then also be negative because it negatively impacts our owner's equity. Now let's say you knew exactly how to deal with the inventory, but you're unsure about the owner's equity. If I've got a negative 2,250 on the left-hand side of the equal, then I need to have a negative 2,250 on the right-hand side. Now, because liabilities has nothing in it, this will be exactly the same as what is on the left-hand side. So the asset, and you just duplicate the signs. That is how you make sure that you balance your accounting equation. Okay. Question 2.4. We paid custom duties of 1,800 by check. Now, because we know it's by check, it would be in our cash book payments. So what we will have is a check counterfoil, is our source document. It will be original as well. And then assume the periodic inventory system. Okay, because we have a periodic inventory system, we take it to the individual expense account, which in this scenario is custom duties. Okay, so we don't take it to inventory, we take it to custom duties. So what would the journal look like? We would say, okay, fine, we pay, the bank would decrease, and our custom duties, which is an expense, would be debited, would increase. Custom duties would affect owner's equity, but it would affect it negatively, and the bank is an asset account, and that would also be negatively affected. So let's go fill this in on our form here. So our check counterfoil would also be the original check counterfoil. Okay, we would have our cash book payments journal, and then we would use custom duties as our account name and not inventory because we use a periodic inventory system. We would credit the bank account, and then you would see because we credit bank, our bank account reduces with 1,800, and therefore owner's equity will also negatively be impacted by 1,800. So for expenses and income, when you think owner's equity, remember income increases our profit, so it will increase your owner's equity. Expenses decreases your profit, so it will decrease your owner's equity. That's how you need to think about it. Okay, do you guys have any questions on question 2? Do you guys have any questions on what I did for question 2? Any questions so far?